Hello everyone, and welcome back to the channel. Today, we're diving into a topic that's set to fundamentally change the way we look at financial statements. We're talking about the brand new accounting standard, IFRS 18, which is all about presentation and disclosure in financial statements. So, what's the big deal with IFRS 18? For years, the International Accounting Standards Board, or IASB, has been working on a project to improve how companies communicate their financial performance. Its result is IFRS 18, which was officially issued in April 2024. This new standard is designed to bring more transparency, comparability, and discipline to the income statement. It's replacing the old, less prescriptive IAS 1, specifically the parts about presenting financial statements. Think of it as a major upgrade for financial reporting. One of the most significant changes introduced by IFRS 18 is the creation of new strictly defined subtotals in the income statement. For the first time, we'll see mandatory categories that every company using IFRS will have to follow. Let's break them down. First up, we have the operating profit or loss subtotal. This is a game changer. Previously, companies had a lot of flexibility in defining what operating profit meant. Some would include certain income or expenses, while others wouldn't, making it incredibly difficult to compare apples to apples between different companies. IFRS 18 puts an end to that ambiguity. It provides a clear definition, requiring all revenue and expenses from a company's main business activities to be included in this category. Things like restructuring costs or gains from selling a subsidiary, which might have been presented differently before, will now have a consistent home. This brings a level of discipline we haven't seen before. The next new subtotal is profit or loss before financing and income tax. This is essentially your operating profit, plus the results from investments and financing activities. The standard carves out a new investing category, which will include income and expenses from assets that generate a return individually, like rental income from an investment property or dividends from shares held in another company. This gives investors a clearer picture of how a company is performing from its core operations versus its investment activities. Finally, we have the familiar profit or loss for the period, which we all know as the bottom line. So, the new structure will flow logically, from operating profit down to profit before financing and tax, and finally to the net profit. This structured approach is designed to tell a clearer story about how a company generates its profits. It separates the core business performance from the impacts of financing decisions and investment returns. But why make these changes? The IASB's goal is simple: comparability. Imagine you're an investor trying to decide between two companies in the same industry. Under the old rules, one company might report a very high adjusted operating profit by excluding certain costs, while the other is more conservative. It was confusing and often misleading. With IFRS 18, everyone plays by the same set of rules. When you see operating profit, you'll know exactly what's in it and what's not, no matter which company's report you're reading. This will make financial analysis much more reliable and efficient. Another huge part of IFRS 18 is the crackdown on what are known as management performance measures, or MPMs. You might know them by other names like non-GAAP measures, underlying profit, or adjusted EBITDA. These are the custom-made metrics that companies often highlight in their press releases and investor presentations, arguing they provide a truer picture of performance. The problem is, these MPMs have been like the Wild West of financial reporting. Companies could define them however they wanted, often excluding expenses they didn't like, such as stock-based compensation or acquisition costs, to make their results look better. This created a huge gap between the official audited profit numbers and the figures presented by management. IFRS 18 doesn't ban these measures, but it brings them under strict control. For the first time, companies will have to disclose and explain their MPMs within the financial statements themselves, in a single note. They will have to provide a reconciliation showing exactly how they got from the nearest IFRS-defined subtotal-like operating profit to their custom metric. They'll also have to explain why they believe this measure is useful and how they calculated it. This is a massive step towards transparency. It forces companies to be accountable for the alternative numbers they promote, allowing investors to scrutinize them properly. No more hiding adjustments in the fine print of a press release. So, we've got new subtotals in the income statement and new rules for management performance measures. What else? IFRS 18 also enhances the requirements for disaggregation. This means companies will need to provide more detailed breakdowns of their income and expenses. The standard encourages a more granular view, helping users of financial statements understand the specific drivers behind the numbers. For example, instead of just seeing a single line for other income, a company might need to break it down into its key components. This is all part of the overarching theme of clarity and transparency. Now, let's talk about the timeline. When does all this come into effect? IFRS 18 is mandatory for annual reporting periods beginning on or after January 1, 2027. That might sound like a long way off, but for large organizations, the preparation needs to start now. Companies will need to update their accounting systems, chart of accounts, and internal reporting processes to capture the data needed for the new categories. It's not just a simple relabeling exercise. It's a fundamental change in how financial data is structured and presented. Early adoption is permitted, so we might see some forward-thinking companies making the switch sooner. When the standard is adopted, companies will also need to restate their prior year's financial statements to conform to the new presentation format. This means that in 2027, you'll be able to compare the new IFRS 18 compliant income statement directly with the restated 2026 figures, ensuring a like-for-like comparison from day one. Who will be most affected by this? Of course, accountants and finance teams will be on the front lines, implementing the changes, but the impact is much broader. Investors and financial analysts are major beneficiaries. They will get more comparable and transparent data, which should lead to better investment decisions. It will be easier to spot red flags and to truly understand the operational health of a business, separate from its financing structure or one-off gains. For businesses, while there is an initial cost of implementation, the long-term benefit is a clearer financial story. A well-structured income statement can help management communicate its performance more effectively to the market and could potentially even lead to a lower cost of capital as investors gain more confidence in the numbers. In summary, IFRS 18 is arguably one of the most important accounting updates in over a decade. It brings three core improvements. First, a structured income statement with mandatory, clearly defined subtotals like operating profit. Second, it brings discipline and transparency to management-defined performance measures by requiring detailed reconciliations and explanations within the financial statements. And third, it enhances requirements for disaggregation, providing a more detailed view of a company's performance. This is all about building trust and confidence in financial reporting. It's a move away from letting companies mark their own homework and towards a standardized, globally consistent framework. It's a big step forward for corporate transparency, and it will empower everyone who relies on financial statements to make better, more informed decisions. Implications and challenges. Entities will need to redesign their financial statements, especially the income statement structure. IT and reporting systems may require updates to handle new categories, subtotals, and disclosure requirements. Communication strategy may need overhaul, especially how performance is communicated to investors using MPMs. Ensuring proper audit and control over MPMs will be critical due to increased regulatory and user focus. Some complexity in aligning entities' business model with where certain incomes, expenses are classified operating, investing, or financing under the new categories. Thanks for watching, and I'll see you in the next one.